Unfortunately, something terrible is happening in the stock market, and it's important that you know what's going on. I've been a financial advisor for over 20 years, and I'm sounding the alarm because I think we all need to hear this. But first, we need to understand where we are. As I record this, the S&P 500 is almost at an all-time high. It's about to break 6,000. And over the last 12 months, the market, the S&P 500, has been up a little over 35%, and year to date it's up over 25%. Those are big moves. And how does this compare historically? And is it setting us up for pain? And if it is setting us up for pain, what can we do to protect ourselves from it? Okay, a common question I get asked is, hey, Azul, is the stock market overvalued? Is the stock market going to go through a correction? Is it going to crash? And I can tell you that yes, the stock market is going to crash. But what I can't tell you is when. This irrational exuberance can continue for a long time. What tends to happen is the stock market tends to take the escalator up, but unfortunately then it takes the elevator down. In other words, it takes a while to get a return. Now, that 12-month return of 35%, that's a big return in a relatively short period of time. But remember, anything that can go up by 35% in 12 months can also go down by 35% in 12 months. So we want to be careful. So is the stock market going to crash? Yes, it is going to crash, but what I don't know is when. Could this continue for another year, another 2 years, for another 3 years? Yes, absolutely. But the time to prepare for a crash is before it happens. And we have time now, so I want to make a case for where is the stock market valuation now? What does that mean, and what should you be doing? Okay, the first valuation metrics that I want to go over is the Warren Buffett indicator, which Warren Buffett came up with this, and he says he looks at the total value of a country's stock market, in this case the US, what's the total US stock market value, and divides that by the gross domestic product of the country. So what's the value of the public companies that are producing these goods and services, and then what's the gross domestic product of the country in which these companies are based. So you can see as of recently here, this is as of May 31st, 2024, the value of the total US stock market was just under $56 trillion, and US economy was about half of that, 28.38. So it's almost 2x, it's 197%. And this is how the Buffett indicator compares historically. You can see those bands there, the red one and what looks to me like yellow. Those are 1 and 2 standard deviations above what the normal is. So you can see right now, we're above 2 standard deviations compared to what this has been historically, going back to the 1950s. So I want to thank Current Market Valuation for that study. Okay, now let's go to Investopedia. What is the CAPE ratio? It was developed by a PhD by the name of Schiller, and it's a valuation measure that looks at real earnings per share over a 10-year period to smooth out fluctuations. It goes on to say the CAPE ratio is a valuation measure that uses real earnings per share over a 10-year period to smooth out those fluctuations in corporate profits that occur over different business cycles. Okay, so what does this mean? Instead of, many of us have heard of price to earning. It's just for every dollar of corporate earnings, what people are willing to pay for that. So if a company has a PE ratio of 20, it means people are willing to pay $20 for every $1 of the company's profits, earnings. And the CAPE ratio is an acronym for cyclically adjusted price to earning ratio. It was popularized by Yale University professor Robert Shiller, and it's known as the Shiller PE ratio, known also as the CAPE ratio. The PE ratio is a valuation measure that measures a stock's price relative to the company's earnings per share. And here you can see what that CAPE ratio is. Again, thank you to Current Market Valuations. Importantly, you can see the dot-com bubble. in 1999. You can see what that looked like there. We were above 2 standard deviations. Looks like we actually hit 3 standard deviations. Where are we now? We're right at 2 standard deviations above. So A, is the stock market inexpensive? No, it's not inexpensive by any measure. And I don't think people think it is. Here, let's go for a walk and we'll chat some more about this. So now I'm going to talk about what this means to us. So we all agree that the stock market is not inexpensive right now, but the question is, what does that mean to you and I? What should we be doing based on that? One of the things we need to be careful of is just because the market's at a high valuation doesn't mean that it's going to crash. It means that if there is a correction, it could be a bigger correction. But again, this could go on for another year, another 2 years, another 3 years. What I do know that we should be doing right now is we should make sure that our long-term asset allocation is right for us. Right? If we should be 60-40, 50-50, whatever that allocation is, stocks to bonds, the time to prepare, the time to make an adjustment to our asset allocation is before there's a stock market correction, right? I mean, given that big move that the stock market has just gone through in the year to date and in the last 12 months, and really since it's been a long run, right? We had a pullback at the beginning of COVID, but then with all those stimulus checks, the market was really supercharged. So it's really been a strong decade for the stock market. And it's easy to get over allocated to stocks when things are going well. And we have had some warnings along the way, right? When COVID happened, that was a wake-up call to a lot of us. The S&P 500 dropped 30% in 4 weeks. It was the most rapid decrease in the stock market in US history. And that gave us a sense, that reminded us what it feels like to go through pain. Now, in the case of COVID, the market came roaring back and actually finished 2020 in a positive territory. But it's not uncommon for the stock market to take 2, 3, 4 years to recover once there's a correction. So I'm trying to encourage you to look at your asset allocation now, because once the market goes through a correction, 1, it can happen quickly, but 2, it can be a while that you're in this painful state. If you find yourself during a market correction overexposed to stocks, it can be painful, and it can be painful for a long period of time. It can be painful for several years. There aren't many lost decades in the stock market, but there are some where people were in the stock market, they felt pain, and they felt pain for a decade. That's a long, long time. So the time to look at your stocks, look at your allocation, and ask yourself, is this the right allocation for me? Could I withstand a 20, 30, 40% correction in the stock market? And if you're my age, if you're close to my age, if you're over my age, few of us at that age, once we've already become financially independent, then job number 1 says, protect those assets, don't let them come down. And it's a lot easier to look at our long-term stock allocation and say, you know what, the stock market's up almost a third over the last 12 months. Could you be 10 percentage points over allocated to stocks? Could you be 15 or 20 percentage points? I don't know your situation. This isn't financial advice. I don't know your situation. But yes, that could happen. And if that is the situation, it's a lot easier to make that correction when the market's at all-time highs, when those stocks are at high prices, and say, okay, I got in front of my skis. And I want to throttle back, and I want to reduce my exposure to stocks. So if the stock market does go through a correction, I don't feel the full brunt of that. A lot easier to do it now when the stock market's at all-time highs. And likewise, it's a lot easier to think about enjoying your journey until you get to retire when you're in your 50s and 60s, and you can think about that. And that's why I made this video up here that talks about 8 things to stop doing in your 50s and 60s in order to enjoy the journey until you get to retire. Thanks for watching, and I'll see you in that video. Bye-bye.